at Morgan Stanley, very, very bullish with regard to India. In fact, he seems to suggest that India will stand out within that Asia basket. And let's have that conversation straight with Jonathan. Jonathan, great having you. This is Harsh here. Let me first start off by setting the context. You seem to be suggesting that earnings growth is going to be powerful and India is going to stand out versus global peers on the earnings growth front. But don't valuations largely price in the kind of growth that India expects? I mean, traditionally, India has always grown at double digit. And therefore, what gives you the conviction that India will stand out within that Asia basket?
Yeah, if you look at actually the financial year just ending, Indian earnings has not been double digit. In fact, for the broad market, we think it's been something like 5%, 7% for the sensex. So our view, which is developed by our team in conjunction with Ridham Desai and our local analysts, is that there's a cyclical upswing in earnings that's coming. And that over the next 2 years, we're likely to see mid to high teens earnings growth, which certainly, to your point, should be much higher than we're getting in emerging markets overall. I think it's fair to say that we and many others did not anticipate how bad the earnings cycle actually was last year or the year just finishing. And I think that's to do with the deceleration in nominal GDP growth that happened in India. But what you've now seen is substantial policy easing. Obviously, we've had RBI cuts, but there's been, I think, a CapEx cycle that's starting to pick up again. Some regulatory easing. And so India looks quite good, whereas, in fact, if you look sort of out globally, though there are some bright spots like semiconductor CapEx, the actual earnings environment for emerging markets overall is not as strong.
Jonathan, one of the big triggers which is there for this market is the outflows which is happening from the foreign investors. And while it's getting matched by the domestic inflows, how do you see foreign investors reacting to the fact that Indian market still valued at nearly 21 times forward earnings?
Well, if you look 2 year forwards for the sensex index, where our target is 95,000, we actually have it at about 18 times forward PE, and that valuation premium to other emerging markets has narrowed dramatically. So emerging markets overall are probably around about 13 times forward on the same basis. So at one point, at the top of the whole cycle for India's performance, it was approximately 2x the valuation of EM in aggregate and 2.5x the valuation of China. And on what you call FII flows, so foreign flows, certainly they have been negative. Obviously, for every seller there has to be a buyer. That buyer's tended to be the local in India investors. But you now have a situation where actually within dedicated EM funds, investors are slightly underweight India. And that's the most negative position they've had on India in a decade.
So what will it take for these funds to reverse the positions and the flows to come back to India?
Well, we are seeing reasonably positive inflows to Asia EM equities overall, but I think it's that cyclical story that I mentioned in answer to your first question. At the moment, investors are skeptical about it. There are other question marks they have, including over geopolitical risk, tariff risk vis-a-vis the US. But it's really whether we get that cyclical upswing. And again, just to emphasize, inflation in India, the CPI is tracking below 2%. That is extremely low and low nominal GDP growth. Real GDP growth is high, but nominal GDP growth is what drives revenues and earnings, and that is too low right now.
If you look at, we have a annual budget which is coming in. Do you see some challenges for the government with respect to the fiscal targets, given the fact that nominal GDP is low, below 10%?
So we're expecting a relatively modest fiscal consolidation, so targeting maybe a 4.2% of GDP deficit. You're right that weaker nominal growth does to some extent challenge revenues. Obviously, we've actually also got a GDP base revision upcoming, which will be interesting to see. But in aggregate, if you look at the fiscal or the current account position in India, it's very strong, as is the FX reserve position. And the currency is now well below its real effective exchange rate trend. So the currency is also we would argue, cyclically depressed. So it's quite an interesting story. So 4 years of outperformance. In India, at times we had a very, very large overweight. We pared that back over the last 12 months, considerably actually, running relatively low risk positions generally, given the uncertain world that we're in. But India is one of a number of markets, including Brazil, UAE, Singapore, which is where I'm doing this interview from, that we think will outperform this year.
Right. Jonathan, in the backdrop of all these additional tariffs that Trump has announced, talk to us about how you see India and, more importantly, how are you seeing China placed? Because now his focus tends to be shifting towards the European Union, and China is largely untouched. And in fact, just this morning or late last evening, China has also inked a very positive EV deal with Canada. Talk to us about where you're seeing China headed, because this morning, the macro numbers from China were also very supportive.
Well, again, nominal GDP growth in China is weak, and rather like India, much weaker than real GDP growth. The difference actually is that we don't really see the catalysts for a cyclical recovery in the consumer industrial space in China, but it's an enormous economy with a very diverse opportunity set in equities, including a number of AI plays. But again, back on your tariff question, it's undoubtedly the case that the focus for tariffs right now is about US, EU, and not so much Asia. Most of Asia settled down into an equilibrium vis-a-vis the US. I think what was disappointing from an India perspective is that India didn't actually get any tariff advantage vis-a-vis other Asian countries. It, to some extent, was disadvantaged, but one wouldn't want to overemphasize it because manufacturing exports from India to the US are really quite small within GDP.
So within domestic market, what kind of consumption themes are you looking at? Is discretionary still your bet?
So we have overweights on industrials, financials, and consumer discretionary, broadly speaking. And again, India's great advantage is it's still a young demographic, an urbanizing demographic, forming modern consumption patterns. It's quite an exciting story in that regard, and somewhat unique amongst the large economies in the world. So again, it all just comes down to whether we're right that this cyclical downturn, that I would emphasize it did surprise us and how intense it's been, whether that abates and it actually improves going forward.
Jonathan, one of the things which we've been focusing on in the budget is the CapEx, annual CapEx. Do you think the government will continue with its plan for higher CapEx this year as well? And when it comes to defense spending, it's also expected to go up, in a significant manner. How do you see both of them?
Yeah, so at the sort of the national level and also at the state level, CapEx and infrastructure delivery has been a key positive feature. So public CapEx, private CapEx has been somewhat weak, and inward FDI flows have been probably smaller than we would have thought a couple of years ago. So the question again is whether there's enough perceptions of accelerating private sector consumption growth that will drive private CapEx. That's something to watch, probably more than expecting any big changes in the pattern of public spending.
Jonathan, if I can switch focus back to Indian markets and how you're seeing returns going forward. You're expecting a likely reversal in FII flows. The beneficiaries likely will be banks and IT because those have been the traditional beneficiaries. Talk to us about valuations, therefore. IT is not showing enough steam in terms of growth, and therefore, would FIs be willing to buy at the 20-odd times in terms of the multiple? Will they be valuation agnostic is what I'm trying to get to.
So you're referring, I think, to the IT services names in India. So if you look at those names, that's not a sector that we are particularly enthusiastic about right now. It wasn't in the overweights that I mentioned in answer to a previous question. And I think there the debate is around the effects of AI adoption on the underlying revenue streams for these firms. Now, so far the guidance is kind of, I would say, sort of mixed. We're watching it closely. But as a broad theme, at Morgan Stanley Research, we're moving well into the AI adoption phase, and so that's not where we would be focusing our exposure in India.
Jonathan, you you said you're overweight on financial, but within financials, are you looking at the PSU banks, the private banks, and the NBFCs separately?
So it's more the private banks and the non-bank financial companies that we have an interest in. Obviously, there's a perpetual debate there about those and the valuation premium versus the PSU banks, but it's essentially those private banks. And again, going back to the earlier answer around AI adoption, do bear in mind that the financial sector globally and in Asia is likely to deploy AI technologies to reduce costs. And so that cost out story through AI automation is potentially a very big driver of profit growth for financial stocks. And it's the reason why we're actually overweight financials across Asia.
What are investors telling you when it comes to the debate between PSU banks and the private banks? Because PSU banks have outperformed the private banks in the last 12 months.
Well, that's getting to a level of granularity that's somewhat beyond the discussions that I typically have with investors. But in terms of what's in our focus list right now, we have ICICI Bank and Bajaj Finance.
Okay, Jonathan, talk to us about your view on metals as well as precious metals. The kind of run-up that we've seen in some of the metal names and, of course, the run-up that we've seen in gold and silver. Where do you think this entire segment is headed from here, and do you continue to be constructive here?
Yes, we are, and particularly on the gold exposure, which has been a long-standing theme in our focus list. I think when you're looking at the private client world, the endowments and pension fund world, you are seeing this desire to have a broader range of assets and an increasing weight towards real assets, and that's given the high debt ratios in the G7, the high fiscal deficits, and to some extent, we wouldn't want to overstate it, but to some extent, uncertainty over the US dollar.
Jonathan, you spoke about the fact that you're looking at 18 times for the sensex in the next 3 years. If I ask you to look at the sectors that would be driving that growth, earnings growth, so that you see a much more muted or lower valuation, you said you're overweight on a couple of sectors, but do you think that there could be other sectors that also will play a bigger role in as earnings growth come in?
Well, if you look at the core overweights we have in financials, industrials, broadly speaking, and consumer discretionary, that's the majority of market cap. So you're really talking about areas that may have more question marks over them, like IT services, pharma. But yeah, you've got quite a broad array of market cap that should be delivering earnings growth. And that 18 times forward, just to be clear, is to March 2028.
And how do you see flows into various Asian countries? I mean, where are the flows moving out? I mean, you're seeing a continuous outflow from India, but within Asia, which are the countries where you see these flows moving out to?
Well, some countries have inflows and some have outflows. The inflows are particularly to North Asia, so to Korea and Taiwan, around the semi-CapEx story, the very strong demand for memory names, which are very present, obviously, in the Korean market. To some extent, positive flows towards China, but again, it's more the domestic investor that's in the driving seat on China. Southeast Asia broadly is not attracting investor attention. There tend to be outflows there. EMEA and Latin America, again, it's quite selective, but I would mention that there are positive flows towards Brazil. Brazil has a lot of real asset plays in it in the commodity space, and that's attracting interest.
Jonathan, it's the global geopolitical landscape has become like a chessboard of sorts, and a lot of the moves are being played by the US, surprisingly. Give us a sense as to what this does in the global market context, in your opinion. We've obviously seen a very strong rally, and in fact, we have the White House or US government officials also commenting about the kind of rally that they've seen in global markets as a result of US policy. How do you view those comments, and what's your take with regard to valuations globally?
Okay, so that was quite a broad question.
That's true.
But the way I think I will answer it is in relation to something we noted last week, that geopolitical risks generally remain high. and yet equity volatility globally has been really very low. We were dealing with a level, for example, on VIX of below 16 times in the middle of last week. And yet we know that last year we had multiple spikes in volatility as the year went on. In fact, the VIX peaked at over 50 in April of last year. And so we were basically pointing out this sort of disconnect between arguably a degree of investor complacency in relation to low volatility and the fact that geopolitical risks are still present.
Jonathan, if you look at the theme which played out in 2025, it was more of AI and semiconductor CapEx. Do you think that that same theme is going to play out in 2026, or is there going to be some kind of moderation in that theme, and and investors will start looking at other sectors as well?
Well, it's only one of a number of sectors that we recommend. We like Asian defense stocks. I mentioned the broad overweight on financials, consumer discretionary, things like gold miners. But yeah, certainly some segments of AI CapEx as they affect Taiwan and Korea are remaining very strong, at least on our forecast horizons, particularly in the area of memory, where there are outright shortages right now.
Okay, and Jonathan, we've spoken about Korea quite some bit. South Korea, the KOSPI, has shown exemplary performance, outperforming all of its Asian peers and in fact some global peers too in the calendar year gone by. More than a 75% to 80% uptick in the KOSPI index.